Over the years, many prominent business practitioners and theorists have postulated that one way for a company to increase its return on capital is by increasing its market share, and studies appear to have confirmed this relationship. However, innovation and technological developments have made it difficult for many companies to barely survive, but yet grow their market share. But even then, there are some companies that constantly overhaul themselves and keep apace, ensuring not only their survival but their leadership position. In fact, there are a handful of companies that are so dominant in their industries that it seems highly unlikely for them to lose their leadership anytime soon. Last month, I set out to identify the most dominant companies in their specific sectors or categories that are likely to retain their top position over the next 10 years. So as to avoid any ambiguity, I decided to restrict our study to only those companies that enjoy at least a 50% share or more in their respective categories. In the first part of our leadership series video released last month, I covered an Ahmedabad-based firm whose solid grip on wellness has set it up for 10 years of dominance. If you missed watching that video, you can click on the link below to watch it. In the second part of our series, we are going to cover an obscure company that is not very widely covered, but yet has a dominant 65% global market share in the niche segment it operates within. And guess what? It seems like it is going to continue its reign of dominance over the next decade. The word chemical brings about a general feeling of disenchantment even among savvy investors smitten by renewables, auto, banking and defense, since they are easily understandable businesses. And frankly, chemicals does seem like a boring business as compared to artificial intelligence, drones or electric vehicles. But chemicals are a constant in-demand good, satisfying the fundamental tenet of long-term value investing. Everything from toothpaste to detergents to paper, salt, medicine, paints, resins, and cosmetics contains some sort of chemical, making it a crucial component of the industrial sector. In recent times, the chemical sector has seen mammoth tailwinds due to initiatives being taken by Western countries to avoid concentration of manufacturing activities in China. India is the sixth largest producer of chemicals in the world, and the total industry size stood at 104 billion euros in 2021. India's specialty chemical sector has been playing a pivotal role in driving the chemical industry's growth. It constitutes approximately 20% of the total chemical market in India by value, and it is expected to grow 12% to reach an estimated $64 billion by 2025. Further, it is expected to provide an opportunity of an additional $60 billion across specialty chemical segments over the next 8 to 10 years. But what makes specialty chemicals a segment to watch out for is the role it plays in enabling India's advances in megatrend industries such as nutrition and wellness, hygiene and personal care, water treatment, lightweight vehicles including EVs and renewables. With such optimistic projections, there is bound to be strong competition amongst the leading specialty chemical companies. However, there is one company that stands apart as it enjoys a dominant market share not only within India, but has a global share of 65% within a niche segment within which it operates. And this has helped the company grow its revenues from under 35 crore rupees in 2003 to 1,600 crores in 2022. That's an absolute growth of over 4,500% over the last 20 years. In the 80s, Vinod Saraf worked in the chemicals manufacturing division at the Aditya Birla Group owned by the late Aditya Birla, billionaire Kumar Birla's father. Impressed by his work, he was soon made managing director of an upcoming refinery. But in 1989, Saraf gave it all up to start a small specialty chemicals venture. Today, Saraf, chairman of Vinati Organics, is a billionaire himself with its company's market cap currently close to 19,000 crore rupees. Vinati Organics Limited, or WAL, is among the leading global manufacturers of specialty chemicals. WAL is the largest manufacturer of isobutyl benzene, that's IBB, and acrylamide tertiary butyl sulfonic acid, that's ATBS, in the world, commanding a 65% global market share in both these product categories. The company exports about 75% of its production and has around 300 customers. Global chemical manufacturers like Dow Chemical, BASF, AkzoNobel, and Ecolab are major clients of the chemical manufacturer. Almost every person at some point in their life may have used the drug ibuprofen. After all, it is one of the most widely used drugs across the world. Ibuprofen is used to relieve pain from various conditions such as headache, dental pain, body pain, arthritis, or also used to reduce fever and relieve pain due to the common cold or flu. The primary raw material for ibuprofen is isobutyl benzene, or commonly known as IBB. But even though it is so widely used, surprisingly, IBB was not being manufactured in India and was imported from China and other countries. Saraf realized this presented him an opportunity to start his own IBB manufacturing business. Hence, initially, WAL started operations in 1992 with just one product, IBB, with 1,200 metric tons annual capacity at its plant in Mahad, Maharashtra. Initially, American customers were reluctant to import IBB from a new Indian supplier. But with Saraf's persistence, he was able to convince them to buy his product in small quantities and over time gradually increase its export. Soon, WAL also started supplying IBB to China, Europe, and other countries around the world. Towards the end of the 90s, WAL put in incremental investments to boost production capacity and became the largest manufacturer of IBB in the world. As we mentioned in the first part of this series, released last month, one of the key characteristics that makes certain companies so dominant is their first mover advantage. WAL clearly had that as it pioneered the production of IBB in India and then built on that to become the largest manufacturer of it in the world. But getting to first place doesn't always ensure that you remain there forever. Saraf and his team have never been ones to rest on their laurels. It seems Mr. Saraf had the Make in India theme in mind long before our Prime Minister Narendra Modi launched his ambitious campaign. After having tasted success with IBB, Saraf was on the lookout for an opportunity to pioneer manufacturing of another product in India. In the year 2000, Saraf approached the National Chemical Laboratory in Pune to explore other feasible and profitable production opportunities for WAL. Because of its numerous and diverse applications, acrylamide tertiary butyl sulfonic acid, or ATBS, was identified as one of the potential products. At the time, there were only two other manufacturers of this product in the world, one of which was Lubrizol, the American specialty chemical giant. ATBS is a versatile molecule used for making polymers. It is also used in water treatment, construction chemicals, medical applications, personal care products, emulsion coatings, adhesives, and textile chemicals. However, probably its most important application is in enhanced oil recovery, where it is used in its highest possible purity grade. WAL yet again took up the challenge to become India's first and only the third company in the world to manufacture ATBS. A plant was set up in 2002 at Lote, Maharashtra with 1,000 metric ton production capacity per annum. However, the project was plagued by quality issues in its initial years and was rejected by WAL's global clients as it did not meet their quality parameters. At the time, WAL was still a small company and had exhausted all its resources and expertise available. As the ATBS plant was a loss-making unit, WAL considered shutting it down or selling it off. But fate had other plans for the company. Right about then, Saraf's elder daughter, Vinati, after whom the company is named, had joined the company. She realized that as this was a niche market and Wall was only one of 3 companies in the world making this chemical, if they could get this right, ATBS could be the trigger that could take Wall to the next level. Vinati hired a consultant, ironically a retired Lubrizol executive, to help them address these quality problems. This resulted in a major breakthrough, and Wall figured out how to greatly improve the quality of its ATBS. After that, there was no looking back. Over the next few years, Wall quickly ramped up its production of ATBS to 26,000 tons, becoming the world's biggest manufacturer of the chemical. And like they say, fortune favors the brave. In 2018, Lubrizol, which had a 20% market share of ATBS, completely exited operations. Since then, Wall has further ramped up production to 40,000 metric tons, leading to Wall's market share gaining from 45% to 65% globally as of today. Hence, today, Wall dominates the market with 65% share in both of its primary products, IBB and ATPS. Being the lowest cost producer of both these chemicals, Wall is miles ahead of the competition. The company is poised to maintain its leadership in both these products as it manufactures these chemicals through a closely guarded technology which very few companies in the world possess. Cost leadership and scale economies in IBB and technological entry barriers in ATBS are great strategic advantages. New entry into this segment with similar technological strengths is very difficult. The technologies used are inimitable due to exclusive tie-ups. Further, the products manufactured by Wall are specialized chemicals used for specific purposes. There are no substitutes available for the products as such. Widely used for oil recovery applications, ATBS revenue is highly resilient to oil market mood swings as lower oil prices reduce raw material costs, enhancing margins, whereas higher oil price increases ATBS demand, helping the company's top line. Finally, as the company only makes niche products and there are only 2 or 3 manufacturers in the world, Wall's customers get into long-term contracts with them. This ensures that margins remain fixed, and as customers place orders in advance, it also gives the company visibility of orders for the next few quarters. Over the years, the company has evolved from being a single product manufacturer to an integrated business offering a wide range of products to some of the largest industrial and chemical companies across US, Europe, and Asia. Wall's product portfolio comprises 20 plus products, majority of them being market leaders. In addition to the company being the largest manufacturer of IBB and ATBS in the world, Wall is also the largest manufacturer of the chemicals butyl phenols, IB, and HPMTBE in India. The company's product portfolio is niche and enjoys a massive export opportunity, which the government is encouraging significantly as part of the Make in India initiative. Wall's new product initiatives is expected to lead to significant growth in the coming years. Wall has already lined up substantial capital expenditure plans, which will create a significant headroom for growth. The demand for high-grade ATBS has increased in recent years with the current shortage of the product globally. Hence, the company is going ahead with an expansion of ATBS capacity by 50% to 60,000 metric tons, keeping in mind the demand perspective for the next 4 to 5 years. The expansion is expected to be commissioned by December 2023. With no other competitors having announced plans to increase capacities, this could lead to Wall gaining further market share to possibly even 80% of the global ATBS market in the future. The company has been able to sustain growth and market leadership in key products due to its unwavering commitment to research and development. On an average, Wall's R&D team works on the development of 10 to 12 new products most of them niche with unique chemistries that cannot be replicated. The company is looking at bringing out new products over the next 5 years that will further boost revenues. Wall is also expected to complete its merger with Viral Additives Private Limited or VAPL in 2023. VAPL is engaged in the manufacture of antioxidants used in plastics, LDPE, LLDPE and polypropylene. The merger with VAPL is expected to enhance the synergies of both entities. This integrated business model will further strengthen with the use of butylphenols and IB for antioxidants, a 10,000 crore rupees market opportunity that VAPL addresses. Antioxidants present a huge market opportunity, and post the amalgamation, Wall will be the largest or only manufacturer of some of the antioxidants in India. Currently, global demand of antioxidants is estimated to be around 300,000 metric tons, while the same for India is 10,000 metric tons. Viral Additives has capacity of 24,000 metric tons, which means that it could meet the entire demand for India as well as import the rest to meet global demand. Similarly, India's demand for butylphenols is expected to remain at 25,000 metric tons against global consumption remaining at around 400,000 tons. Since Wall is the only manufacturer of butylphenols in India, the company is looking at substituting the entire imports and also capture potential global market share. With that in mind, the company has announced a capex of 100 crore rupees to increase production capacity by 42% to 50,000 metric tons per annum by the end of 2023. Previously, one of the key concerns of investors was the product concentration risk in Wall's business model. After all, IBB and ATBS still contribute close to 70% of the company's total revenue mix. But with the new products such as antioxidants and butylphenols picking up steam in recent years, and with the expected launch of newer products, Wall is expected to become a diversified business over the next few years. The global market size of antioxidants and butylphenols is huge when compared to Indian markets. Additionally, both these markets are growing in nature. Wall could succeed in capturing market share at a global level in the future due to the combination of two factors: growing market and technology-focused process development, a key execution strategy that Wall has demonstrated for its earlier successful products. Currently, Wall is largely an export-oriented company, with exports contributing to 75% of its revenues. With new set of products increasingly contributing to domestic sales, Wall's share of domestic revenues could increase sizably. And then there is the long-awaited launch of Vinati's para-aminophenol or PAP project, an intermediate for manufacturing paracetamol. Paracetamol is one of the most widely used pain reliever and anti-fever drugs. More than 80% of PAP is used worldwide to manufacture paracetamol. The total demand of PAP in India is fully met through imports, that's 25,000 metric tons per annum. Vinati Organics is expected to grab this as an import substitution opportunity with a cross leadership in manufacturing PAP due to its novel manufacturing process. The company has applied for the PLI scheme and is evaluating its feasibility. If undertaken, this project could generate an incremental revenue of 500 to 600 crore rupees. However, it is pertinent to know here that as of now there is no further update on whether the company is still pursuing this project actively. The total capex expected for the ongoing expansion is likely to be around 600 crore rupees over the next 2 years. The company's strong balance sheet will enable it to fund the entire capex through internal accruals. If one was to look at Vinati Organics, the company has had two major phases. First, where the company started off with a single product IBB and its initial unsuccessful foray into manufacturing ATBS right up to 2006. And the second phase, wherein the company's product ATBS was widely accepted and the company was able to get key international clients like BASF on board to buy its products such as IBB. Over the years, the company has enjoyed consistently high EBITDA margins due to ATBS, which has a higher margin, but since 2020, the margins have declined. This is because the performance of Vinati Organics is driven by a shift in the revenue mix towards lower, albeit healthy margins, such as IBB and butyl phenol, compared to ATBS, as the company makes a conscious effort to reduce its overdependence on it. However, the management expects the margins to stay at the current levels of 30% over the next couple of years, as it consciously aims to bring the revenue contribution of ATBS to around 40% levels. It's hard not to be impressed by Vinati Organics' returns on capital. The company follows a strict criteria to produce only niche products with a target of minimum 20% return on investment and a payback period of up to 5 years. Over the last 10 years, WAL has delivered an average ROCE of 33%, and the capital employed within the business has risen in that time. As of 31st March 2022, the company remains debt-free. Revenue jumped from 741 crore in 2018 to 1,613 crore in 2022, while net profit zoomed from 144 crore to 347 crore rupees over the same period. The company has delivered a 5-year CAGR for revenue and net profit of 19% and 20% respectively. In 2013, WAL had a market capitalization of barely 400 crore, and today it stands at just under 19,000 crore rupees. Over the last 10 years, WAL's market cap has surged 49 times as investors have lapped up the company's shares. With an unchallenged dominance in a particular segment, investors can look at some of such companies which are unlikely to lose their leadership anytime soon and potentially find likely winners. However, bear in mind that a company might be the leader in its industry having a near monopolistic market share, but even if it has a track record of sustained profit and sales growth, current valuations might not be enough. In such cases, it is prudent for an investor to keep such companies on their stock list and only consider investing in them when valuations seem fair. It's crucial to conduct your due diligence before making any investment decisions. Despite the favorable outlook, don't overlook the significance of sustained research. Investing your hard-earned money should not be taken lightly, so make sure to conduct thorough research before making any commitments. Take the time to meticulously analyze the financial statements of potential investment opportunities. With that, we conclude our coverage of the second company that could continue to dominate its industry and remain the leader over the next decade. Hope you found this information useful. Stay tuned for the next part in our series to find out the next company on our list. Happy investing. Goodbye.
Thank you for tuning into Equitymaster's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.